I'm Charlotte McLeod with the Investing News Network, and I'm here today with Simon Popple. Simon writes the Brookville Capital Intelligence Report, which is designed to help investors in the commodity space. This is part 2 of our 2-part interview. If you missed part 1, you can find the link in the description below. It covers Simon's approach to investing in junior resource stocks. This second section is a case study on Chalice, a company where Simon used his system to great success. Simon, why don't you start off by telling me what first introduced you to Chalice?
I first told people about it on my website when it was 12.5 cents. And then I started doing the research, and by the time I finished that, it had crawled up to about 15.5 cents. They found some great precious metals, and the share price went to over $9. But what I can do, which may be helpful, is kind of explain to you why I initially chose them, and use the bridge system to explain that, and then it gives people a kind of I suppose a real life case study of what happens when the system really works out.
For sure, yeah. So I don't know if you want to work through each point individually, or remind us perhaps what the bridge acronym stands for, and we can go from there.
No, sure. Look, let me first remind you about what it stands for, and then I can perhaps touch on a few of the points that attracted me to Chalice. Bridge stands for balance sheet, resources, infrastructure, diversification, grade, and exploration potential. Now, with Chalice, all of these sort of had an angle really, but I mean, the balance sheet, when I first wrote them up, the market value was 41.3 million, and they actually had 21.3 million in cash. And so essentially that meant that their assets were being valued at about 20 million, which I thought was incredibly cheap. So that sort of stuck out like a sore thumb. A small company with a value of 41.3 million having 21.3 million in cash, I thought was very attractive. And then obviously I started to look at the assets which they had, which were being valued at 20 million, and they had land around Fosterville, which is the highest margin gold mine, I think it's in the world, most certainly Australia, but I think it is actually the world, which is owned by Kirkland Lake. So they had land close to that. So if they had any results similar to Kirkland Lake, the shares would have gone through the roof. They also at the time had a property in Quebec, which was very exciting, very valuable, and they'd already spent about 12 million on it by the time I told people about it. So that was subsequently sold by them. But I thought, well, here you've got a company with a lot of cash, 2 fantastic projects, and that doesn't even touch the size in terms of what really set them alight, which was Julimar. One of the reasons why it was so exciting is you've got a company with loads of cash, some great projects, and obviously they needed a lot of luck to find what they were looking for, but that cash could be allocated across 3 projects, and I thought the odds of them finding something was pretty good. And fortunately it worked out, and the shares really went to the moon.
Right. So when you're looking for companies like this, what tips would you have for investors who are maybe approaching the very wide landscape of junior resource companies? How do they even get started looking for this?
Yeah, I mean, I think this is where, having been involved in the market for so long, it's a huge advantage, because there are a lot of companies out there which are, I use the term bogus, but I mean, you kind of there are certain companies that you want to be a little bit careful of. There's other companies which are sort of highly respected. If you're not familiar with the market, I would suggest that you perhaps look at the shareholder base, see who's already invested in them, because that should give you a few clues. If they've got a strong shareholder base, clearly has done a lot of research in them, that would imply that they pass muster with some people who know what they're doing. And again, jurisdiction is important. I like projects to be in Australia, Canada, North America, and you do need to do quite a lot of research if you don't use someone like myself, because you need to be careful, and you need to have a good look at something, and don't jump in with both feet. And even if someone's giving you a tip about something, a good bit of cynicism probably won't do you any harm.
For sure. Okay, so we know that the bridge system is what you use for looking at junior resource companies. Is it something that you can use for producers, and in what ways does it differ? What do you perhaps want to see from a producer that you wouldn't expect from a junior? How do the criteria differ for you when you approach different levels of companies?
No, sure. Well, I think just running through the system very quickly. B, balance sheet. If it's a producer, I'm less worried about seeing some debt on the balance sheet. I don't want to see too much, and I also want to keep an eye on costs, because if there is some debt, then you want to make sure the costs are low enough that the gold price or silver price, whatever the commodity is, can move down, and they can still generate a decent profit to cover any costs of debt. Resources are very important for junior mining companies. With producers, you tend to be more focused on reserves, which are the highest category of resources, and basically, people want to know that the gold is definitely there. So you have what's called proven reserves and probable reserves, and then you go down to measured, indicated resources and inferred resources. So there's a kind of scale of certainty, I suppose, for want of a better term. Infrastructure, if they're already producing, that is normally in place. It's very surprising it isn't. Diversity, less of an issue because they're generating cash. Grade, again, less of an issue because someone's already had a good look at them before they put the money down to fund the plant. Exploration potential is still very relevant because if you've got a mine that's up and producing and they've already explored 80% of the territory, then there isn't much upside in terms of exploration potential. But sometimes you've got a producer that has got huge exploration potential, and so that there can still be quite a lot of excitement at that part of the company.
Sure. And I know you have a fantasy football kind of analogy that you use in your investing. So maybe you could bring that in here and let us know what that's all about.
Yeah, sure. Well, I mean, when I sort of talk to investors initially, I'm very keen to understand what their appetite is for risk. And so what I do is I try and break things down into a fantasy football format. So your goalkeepers are the lowest risk companies. So they tend to be your multi-billion market value companies. Defenders tend to be still probably market value of a few billion, but they're probably not as global as a goalkeeper. A midfielder tends to be a smaller producer or a company that's fairly new to production. And then the forwards are the riskiest, which tend to be the out-and-out explorers. If you get it right, like Chalice, price can go to the moon. But you do want some diversity because obviously they're not all going to work out, and there could be some losses that you have to take on board as well.
Of course. So we've talked a lot about how to identify a good investment in the junior resource space. I want to also talk about how to know when to sell. So for example, with Chalice, which was going up and up and up for you, how did you know it was time to get out of the market?
Well, to be honest, that was with Chalice. it had done so well for me. It was actually becoming far too large a proportion of my portfolio. So that was really an asset management point of view, thinking, well, does it make sense to have so much money in one stock? But just going back to a more basic level, you kind of need to look at what's driving the share price. There are certain situations where, with a producer, it could be the commodity prices going up. At the moment, uranium's doing very well, so a lot of uranium companies are doing very well. So that may be the driver of the price. It could be exploration. There could be some great exploration results. It might be that they've got some permits agreed, which the market wasn't sure about. So it's very important to drill down as to why the price is moving. If it's moving for a very good reason, then it may make sense to hang on to the shares. But if the price is moving for either a reason you don't understand or because of what's happening with a neighbor, for example, there's a term known as neurology in mining, where if there's a tenement near you that's made a huge discovery, then your company share price could go up a lot because people think, well, that gold or silver or whatever it is could be on their land as well. Now, if that's caused the price of your shares to spike, then sometimes it makes sense to sell because, sure, there could be some gold or silver, whatever it is there, but there could be nothing as well. And if there's nothing, your shares will absolutely, tank. So yeah, you kind of, again, there's no hard and fast rule, but if something moves, you need to have a sort of a look behind what's making it move and then form a view.
Okay, so your system here is obviously very methodical. It's a way to work through all these stocks out there. It's been good for you. But obviously, when people are looking at these companies, it can be easy to get emotionally invested. It can be easy to forget when to sell or why you originally got into the company. So as we wrap up, are there any final words of advice you would offer to investors who are interested in looking at the junior resource space, or maybe they're experienced and are looking to do better in their investments?
Yeah, I mean, look, I was given a really cracking piece of advice, which is, don't think you're smart when you're lucky. And there are quite a few situations where people will invest in something and for a completely different reason, the share's gone through the roof. And they think, oh, I'm a really good investor. And I know the same's happened in the property world, where someone's bought a house or a flat and they put new carpet in, a lick of paint, and they've sold it at a huge profit. And it's not actually the carpet and lick of paint that's moved the price. It's the fact the market's going up. And you can get the same thing in commodity space. If you have invested in a company that's looking for a commodity that is going through the roof and the share price does well, don't be too conceited about it. And you do need to really have a strategy, set that out at the outset, and stick to it. And it's actually quite difficult because with a property, if you want to sell it, then you've got to probably speak to some other people who own it with you. You've got to speak to a property agent. You've then got to find buyers, and there's lots of different points at which you can change your mind. Whereas if you've got a stock that's up, a few %, you have a couple of glasses of wine, you come in from a good evening, and you just click and bang, you sold it. And I had a client do that on Chalice, and he phoned me up and said, it's amazing what you've done. And I said, you haven't sold, have you? And he said, well, yes, I've never got these returns before. And I said, why do you sell? And he said, well, I want to get back in at a lower price. And it never happened. The price just went straight up, and he lost millions basically. He made a lot of money, but he could have made millions more if he'd stuck with it. So yeah, just have a strategy and stick to it.
Perfect. Well, I think that's a good place to wrap up. Thank you so much for being here to talk about your investment strategy. And if anybody did miss part 1, you can find that on our channel here as well. So thank you for being here online today.
That's great. Thank you very much. Really enjoyed it.
Once again, I'm Charlotte McLeod with the Investing News Network, and this is Simon Popple.